that's really what GP-led secondaries are all about, is to not have your ownership structure be the tail that wags the dog, but actually do what is right for the portfolio company to optimize value with the right ownership.
Hello, welcome to Trust Vista Talk. I'm Abhilaf J. Kumar. Today I have with me Justin McDougall. Justin is a principal with ICG Strategic Secondaries Investment Team, which he joined in March of 2015. Prior to ICG, Justin worked with Morgan Stanley's Alternative Investment Partners as a principal on the Private Equity Secondaries Investment Team, and started his career before that in the Private Markets Group of DuPont Capital Management, where he focused on private equity primary, co-investment, and secondary opportunities. Justin, thank you so much for joining us today.
Of course, happy to be here.
You know, you've had a long career in secondaries, which is not that old of an industry to most people, though it's in the news quite often now, and you hear a lot of folks doing GP-led secondaries and new funds being raised. What was the world of secondaries when you first started?
Yeah, it's a good question. I don't think that a lot of people go to school thinking that they're going to want to go find a job in the private equity secondary world. And for me, I started my career, as you mentioned, in DuPont, which is really an institutional investor that were making primary investments in private equity managers. They would do co-investments and secondaries, and so you get a little insight into that world when I started at DuPont. But it was really my time at Morgan Stanley when I joined that team to be their first dedicated team going after the secondary private equity opportunity. They previously did it part of a fund-to-fund strategy, and it was really a sleeve that they broke out and made a separate team and fund for. And back then it was a different world. I started in 2010, so just coming out of the financial crisis. There was a bit of a seize up in transaction volume prior to me joining because the bid ask was so wide. And what really in that moment in time, it was a LP secondary market. GP-led wasn't really a word that existed back then. And in the LP world, really there was an interesting opportunity to capture the kind of the liquidity discount or liquidity premium that existed by buying these illiquid interests in private equity funds, which is very different from the world today. But it was it started to change very quickly. I think Morgan Stanley was at the forefront of it at that moment in time, because you had a lot of private equity managers that were disrupted through the crisis that had a fund that needed a solution. And so pretty early in my career, I actually got exposure to doing what we would now call GP-led secondaries, but at that time we didn't really have a word for it. We would call it, fund restructurings probably would be the common vernacular at the time. But it would be liquid hedge funds that got into trouble, that had to put up the liquidity gates after the financial crisis, that needed some kind of solution. Things of that nature would probably have been 30 to 40% of my time, and that ramped over time when I was at Morgan Stanley to be 60 to 80% in any given period of time towards the end.
You mentioned you didn't go to college thinking you'd want to be a secondaries professional. I'm always fascinated by how people get into the careers they get into, because outside of being a fireman, an astronaut, or a professional athlete, maybe a doctor, an engineer if you're South Indian, there's not many other careers people think about when they're young. What did you think you would be doing when you went to Virginia?
Yeah, I was always attracted to the kind of finance and business path, partly because I had an older brother who works in the hedge fund world, so I got to see a little bit of what that looked like. But I think the fundamental things that attracted to me was, I'd always been somebody that enjoyed playing strategy games growing up, and I just felt like of the professions I could pick from, that one really tapped into that natural drive and interest that I had. And the way that I thought about going into private equity, I was certainly recruiting in a very different and difficult market. It was the fall of 2008 when we were having our interviews for full-time employment, graduating in 2009. but I was very focused. I want to be on the buy side. I want to be an owner and really kind of be invested in what I do. That was important to me. And you know, getting a job early on at a pension fund where you can have that bird's eye view of the private equity landscape and all the strategy that existed was, to me, a very interesting launching point to figure out that next step, which ended up being secondaries. But that's kind of how I navigated at that point in time.
Yeah, 11 years later, you're on the other side of a crisis,
Right.
you know, and you're looking at recruiting. You know, I started my career similarly in graduating in '02, so recruiting in the summer of '01, and I went into tech banking as that bubble burst, right? So now that you're on the other side of this, you know, what would you tell young graduates coming to the market as far as how to think about starting their career and building towards something lasting?
Yeah, I think you need to. It's a very common trap to get into. Think about, you know, your next 1 or 2 year progression when you're first coming out of school, and I think what kind of systematically gets ignored or underweighted in that decision process is the skills you're going to develop, the people that you're going to work under who are going to mentor you, and kind of become champions of your career. Those are probably more important. And I feel like few people coming out of school really appreciate the amount of time and thought that they should be putting into those aspects versus, you know, what's my bonus going to be? What's my kind of promotion cycle going to look like? Don't get me wrong, those are important as well. But when you kind of step back 12 years later and think about what was the kind of key inflection point and the most important thing, those won't be the things that you highlight. It will be the individuals that you had the opportunity to learn from, that were impactful in your progression.
And when you think about the folks you're recruiting, you know, I've seen this, I think since last September, there's been a pickup in activity across private equity broadly, and there's been a shortage of people to do the work. Right? That's meant a lot of clients leaning on Trust Vista more heavily, but when I interview young people in an environment like this, a lot of people are just worried about getting that first job, any job, right? And they'll say,
Yep.
just to get the job. And one of the questions I always ask, if you could do anything, what would it be, right? And it's the same thing. Nobody should be saying what I want to be is a, you know, an analyst of this. Hopefully you say an astronaut or something fun. But how do you actually get to understanding who's going to be a good fit for your team?
It's not easy. I mean, sometimes it's luck that finding the right person. We've gotten better at it over time, and you know, we've gone long stretches of interviewing people and just not pulling the trigger. And you know, I think there's a lot of information. To me, the most important thing, particularly for a junior individual on a team, the most important thing is their natural interest in the role. And obviously they need to be smart, they need to be intellectual, but if you are passionate and naturally interested, you will get up to speed. You will figure out problems, you know, the solution yourself. You will become resourceful and autonomous. And I think we've gotten better at finding those people. And you know, to some extent, as we've gotten larger, it's gotten a bit easier because in some cases they found us. And that's always a good indicator, right? When somebody is so interested and passionate about wanting to be in your team and doing what you do and learn from you, that you know they've done the research to talk to all your competitors and they said this is the group that I want to be in. You know, it becomes a pretty obvious decision on our end. You know, assuming that they've kind of had all the prerequisites and the qualifications that they need to have.
And when you joined ICG, you know, 6 years ago as an associate, it was a fairly new team and strategy within ICG, and you were at Morgan Stanley, a very large established firm. How did you make that switch from a, you know, an established firm to effectively what was a startup at the time? How did you approach doing diligence?
I had an interesting story because, you know, Morgan Stanley, as I mentioned before, I was doing GP-led secondaries, and not a lot of people in the secondary world could have said that 6 years ago, because it just wasn't a big market. And it just so happened that was a niche that Morgan Stanley kind of played in. And because of that, when I made that decision, Morgan Stanley was actually in the process of thinking that they would be the first to have a dedicated fund to do GP-led secondaries. And so it was a bit of a crossroads for me where we were going to launch that initiative, and they raised that fund. But Morgan Stanley raised that fund, and for me, it was the opportunity to start with a clean sheet of paper and say, if I were to design a strategy and a team to go after the opportunity that exists within GP-led secondaries, what would that be? And in many ways, that's different from what you have in a traditional secondaries organization. And what I mean by that is that when you're buying LP interest and diversified, exposure to secondaries and LP interest, oftentimes you're relying a lot on manager quality. And what ends up becoming secondary is your underlying asset quality, the quality of underlying management team, and your entry price. But if you are doing GP-led secondaries, what you're inherently doing is you're actually getting exposure to more concentrated portfolios, or in some cases, just single companies. And the type of diligence and the type of ownership that maximizes value in that strategy, I think, is quite different and much more akin to what you see in direct private equity. And that's what ICG was bringing to the table. They had a team that came out of Vision Capital, 3 senior partners, Ricardo, Andrew, and Christoph, that had all worked together for close to 10 years at that point, that never did an LP secondary trade in their life. And actually, that's kind of the perspective that I brought to the table a little bit, was how this world kind of operated. But they were looking at the opportunity set in a way that I thought that the industry had blinders on and were missing, very attractive investment opportunities that existed. And so that was something that was really compelling to me. And obviously there's an entrepreneurial, element to it, where when you're younger in your career, taking that risk early on is, in my view, calculated risk early in your career is the right way to progress. And so, it just was a good moment in time for me from that perspective. I'd say it was a difficult moment in time for me from the perspective of I was, in contract to buy a house in Philadelphia. I had no intent or thought that I would leave, but once in a while you get those opportunities and you just kind of know in your gut that you need to do it. I'm very fortunate that I had a supportive wife and who was on board for that decision to cut bait on the house that we were in contract with, and all the friction that was involved in that. And couldn't have been happier with that decision, to be honest.
But you mentioned what secondaries was as an LP-driven market where you're looking at managers, and so you're doing maybe a large volume of assets, but you're not as hands-on. Whereas a traditional private equity firm might do 10 to 20 deals in one fund, right? So more concentrated focus. What you guys are doing is somewhere in between. The volume is much greater than what a traditional GP is, but the work is much more than what a traditional secondaries are, right? So you can say it's the worst of both worlds.
Right.
So how do you guys actually tackle and manage that and still, keep your team lean and add greater value than what others are doing?
Yeah, that's a good question. And I'd say that the key is the fact that we're not doing this alone, right? We're partnering with sponsors and doing what we view as effectively a management buyout of their own portfolio. But if you compared us to, I think the best comparisons to a direct private equity fund, and where are the commonalities, where is the differences? And I think the commonalities is that the type of work that you do up front. What we benefit from that a direct sponsor does not have the benefit or luxury of is, we're partnering with somebody who already owns the asset, right? And so if you think about the diligence process when you're a buyer in a direct private equity fund, you have to really turn over every stone, because they're putting lipstick on a pig in some ways, and if there's a problem, you have to be the person to find it. But if you're actually partnering with the insider and the current owner, they know the issues and they're being transparent with them, and it's our experience in being able to judge that alignment and their approach to the partnership, that it's one that works and is correct for our investors and for our strategy. I think that's a big advantage, but we still have to do the upfront work and the diligence that a direct sponsor would do. I think the biggest difference is what happens after you close the transaction, because that's where, because we have a sponsor that's owned this asset, that has deep relationships with the management team, that has a business plan that they've helped develop that's mid-swing, we're getting a lot of lift and leverage from them in executing that day-to-day activity of the portfolio company. And of course, what's unique about us is that we are continuing to be involved in our portfolio companies because we're concentrated enough where we have the ability to, and we have the background to have credibility in that. But I think that's the key difference, because if we really had to be doing all the blocking and tackling that you would expect a sponsor to do in any individual portfolio company, that's a strategy that's quite difficult to scale in the way that we have over time.
Many of the GPs that you back coincidentally happen to be partners with Chris Vista as well. And given the nature of what you're doing, you don't have a traditional LP GP relationship with a lot of the GPs that you're working with. There's this world of GP stakes investing that's developing in parallel here as well, where those investors are investing in the management company of the GP and often end up becoming kind of advisors and board members almost, if you will, to the GP. How is your relationship with the GPs that you're partnering with, different than what a traditional LP might be?
So, traditional LP, if you think about how, say you make a commitment to a fund, and what's the relationship after making that commitment on monitoring your investment with the GP? And what it typically is that you're going to get a quarterly report. You will have an annual meeting where there'll be a presentation to you, and maybe if you're a large LP, you might have a conversation with the GP once a quarter or once every 6 months, just to go a little bit more into the details of the portfolio. Where we're different is in our deals, we're typically the majority of the capital for a given portfolio company or fund that went through a GP-led secondary. And because of that, we have different kind of information rights and governance that's unique to us, and what you don't typically find even a large LP having. And what that includes, very importantly, is a presence on the actual underlying portfolio company boards, so that we have our own relationship with the management teams. And I think that's important because it allows you to have a different conversation with the GP. When you're an LP, you get everything kind of filtered in the way that the GP wants to present it. That may have some differences in what what your assessment of the reality would be if you were in the room with the board. And it makes it quite difficult for you to have a voice and have a different opinion that you want to have a conversation with the GP, because you're getting that information filtered. So I think it just allows us to be more true partners with our sponsors, right? And for us to add value beyond just capital, because what's interesting in our business is, as we've scaled and as we have over 100 underlying portfolio companies, we see a lot of commonalities, whether it's in industry or just the velocity of going through sale processes, that we have our own differentiated point of view that can add value, to the point where we've actually started to build out an operating partner bench, and have brought these very senior executives that are relevant in specific situations within our portfolio, to help tackle a problem that exists there. And I think that's the benefit that we're starting to see with scale. And it's very much indicative of an active investment strategy within secondaries that I don't think has really existed before ICG came to the scene. And that, personally, that's what gets me very excited about what we do. And when people ask, how is your group or your team differentiated, I think it really hits at the heart of it. And so it'll be interesting to see how this industry evolves down the line, because I think you're going to see a lot more diversity in the types of strategies within the secondary ecosystem.
Yeah, when I speak to entrepreneurs, when folks launch a new fund, they come from an investment background, and they often don't even think of themselves as entrepreneurs when they start a new fund. And I say, no, once you start a fund operations, you're not an investment professional anymore. You're an HR professional, and you're an IT professional, and you're accounting, and you're all of that stuff as well. And when you're small, you can do what it is you like to do, but you get to a certain point where you basically have to become the HR professional. And I think a lot of firms stagnate their growth because of that reason. And I've seen kind of what you guys have done with ICG, where your partners can be really laser focused on the core competencies and strategies of identifying, executing and managing great investments. Where do you see the future of secondaries going from here?
Well, like I said, I think that you're going to see. You are seeing it now, more specialization. So now you have real estate secondary funds, infrastructure funds. We were an early adopter of kind of specializing only on GP-led secondaries. The big evolution that we have seen in the last couple of years is that when we first got started, a lot of the deals that we were going after saw the opportunity and were kind of an echo of the last financial crisis, because you had funds where their portfolio companies were disrupted, their hold periods were extended, and the private equity world has this 10-year vehicle structure that doesn't always work to optimize value of the portfolio company. And I think that's really what GP-led secondaries are all about, is to not have your ownership structure be the tail that wags the dog, but actually do what is right for the portfolio company to optimize value with the right ownership, with the sponsor that knows the most, that's going to create the most value. And I think that is, so what happened from when we started is, it used to be if you had a hiccup in your performance, you would access the GP-led secondary market, and you'd have more time and capital and realigned incentives. But it was, for a period of time, a deal structure that higher quality managers felt would be a stain on their track record or their image. And it's completely changed over the last few years. You see very large cap sponsors with very strong track records. We had the pleasure of working with several of them, like Clear Lake and TPG, that see this as an opportunity to really hold their winners. And where it used to be a portfolio of a fund that's at a time, now it is, I have one company that I really want to own, and I'm gonna kind of cherry pick that gem from our portfolio and put it into a continuation fund. So single asset continuation fund deals have really come to the scene in the last couple of years. I think the other thing that's interesting that's come to the scene is the advisory community has just exploded. I mean, just over the last year, you've seen Goldman, Rothschild, Jefferies, Guggenheim, Morgan Stanley all build out secondary advisory practices, because they realize that this is now the fourth exit opportunity for their sponsor clients, and they need to have that capability to provide that to them. So it's really accelerating now. This is kind of that inflection point where it's becoming very mainstream with all private equity managers, and most have that company in their portfolio where they say, this is the one that I want to do the deal with. And so there's a little bit of a logjam, to be honest, of just supply not being able to make it to market because not enough advisors, not enough buyers. But that's something that's temporary, that's going to change over time. And what we are excited about, and kind of where ICG is positioned within all of this, is if you were doing a single asset continuation fund for a company that was $1 billion plus in equity, there were really 5 groups that could lead it, and you might need 3 or 4 of them to be in it. So you kind of needed the who's who of the secondary world just to get the deal done. So there was big execution risk in doing these deals. And we've kind of gotten our platform to a scale where we can go to a sponsor and provide absolute certainty to a $500 million or $1 billion equity check. And we think that's a game changer, because that just makes it so much easier to not have to herd cats and dogs. We think that is going to be a differentiator. Scale is going to continue to be a differentiator in this market. And it's something I'm quite excited about.
When a GP thinks about exiting, the options are IPOing, selling to a strategic, but increasingly selling to another GP is an option, as you have people specializing in different check sizes. Yeah. But now with the advent and evolution of secondaries and GP-led restructurings, in what situation do you think it ever makes sense for a PE firm to sell to another PE firm versus doing a GP-led restructuring?
That's that's an interesting question. I mean, look, you will have two PE firms that have just a different view of the opportunity for the next 5 years, right? And so I think that naturally will create that dynamic. But you will also have firms that just have a different capability and skill set, where one firm is a probably more natural owner for the next the next stage of growth that a company might have. An example of that that's probably more clear is that when you see VC funds kind of graduate to growth equity companies, and the growth equity firm is going to be the owner of it. I'm sure there are similarities to that, but no doubt in my mind that where this market is going is it's going to capture market share in sponsor-to-sponsor trades. And some of the anecdotes that we've heard from some of these very high quality managers is, some of them have done the analysis where they've looked at all the top performing deals they've had that they then sold to other sponsors. And they said, hold on a second, those were also the top performing deals for those sponsors too. And so, I think there's this process going on right now where they're going to say, well, I'm not going to give that away anymore. And in some ways, this was, I think some groups thought that the way to attack those profile of companies is with long-term capital funds. But the problem with long-term capital funds is that you raise it, but then you have to go find the companies. That's the hard part. And so once you kind of have spent 5+ years with a portfolio company and you understand it well enough to know that it's a candidate for that, an easier kind of bridge to a long-term capital is to do continuation funds. And look, we've actually seen continuation fund deals of continuation fund deals just because there was that much conviction in the growth and trajectory of these companies. But ultimately it's going to be, how do you get it from not selling to another sponsor, but to sell it to the best owner of that asset, whether it's strategic or in many cases it might be an IPO.
You mentioned, the GP who owns the asset knows it better than anyone will, right? Whereas when you're doing a new deal, you have to really get your hands dirty, turn over every rock, and maybe still then you won't know as much as the previous owner. So if I'm an LP in a PE firm that's acquiring for another PE firm, knowing that I could be an LP in the firm that already owns it, I might think the only reason this thing is getting sold is because someone's overpaying for it. And it's interesting, you mentioned you guys are developing a bench of operating partners. So are you actually helping these PE firms be able to add value at that next stage of growth that maybe historically as GPs they weren't involved in?
Yeah, look, I think it's, we have operating partners, individuals or executives that we've crossed paths with along the way who we found to be particularly effective. And in some cases, they've been effective in, helping to turn around difficult situations. And so I'd say where we've gotten the most lift from our operating partners is if something didn't go according to plan. Because I think the downside of a sponsor that has been with a company for a very long time is that sometimes you can have tunnel vision, and you kind of you've been dealing with the dynamic for so long that it kind of takes an outsider's perspective to say, well, hold on, why are you doing it this way? And I think the operating partner bench that we have is kind of allows us to have that conversation with them a little bit deeper into the operations than what we may be able to do just from kind of our board level engagement. And so we've had probably 3 or 4 instances where we've brought our partners in to help. And what's great about it, because some people think about our strategy and say, so you're going to go and you're going to force your agenda onto these GPs that you partner with, and you're going to put your operating partner in and say how things are going to work. And it never works that way. I mean, this is a partnership, and it's where they actually see the value of these individuals, and in many cases have proactively asked us to have them come in, and we try to foster that. We do an annual kind of offsite with all of our GPs. It got a little disrupted over COVID, but that's one of the key learnings that came out of it, where we're able to bring all of our partners together, share best practices, and have them hear about different things that we've done in other portfolio companies and things that have been successful with our operating partners. And then some of them raise their hand and say, hey, can we get that guy over here and help us out? So it's just one of those, it feels like you kind of get on a flywheel to some extent where, you know, the positive results kind of lead to the desire for people to kind of have that happen with them. And it just kind of, you know, the reputation and that feedback loop just kind of becomes self-fulfilling in a way and very natural and organic in how, you know, those individuals end up getting involved in new situations. I think the hard part is expanding that operating partner bench and finding those quality executives that we can kind of do that kind of repeat playbook with. But it's something that just kind of starts to happen over time as you have more of these interactions on boards. I think we probably sit on more boards than most sponsors out there. And so it does give us a unique perspective.
Yeah, you know, you're an LP half the time and you're a GP the other half of the time. So, you know, from putting on the GP hat, if you invest in these great deals, even for yourself, how do you think about exiting versus can I keep my life going in this investment?
Doing a continuation.
Is there secondaries of secondaries?
It's an interesting question. Yeah, we haven't really had we haven't had to deal with that quite yet. It might be something that comes our way though, because and the only reason I say that is because if you think about the evolution of our strategy, we are just now kind of buying and getting exposure to the really top quality assets that would fit that profile. You know, I think if one indicator of that is if you looked at our kind of fund two, our first blind pool fund, you know, the average EBITDA of these businesses would have been maybe in the 50 million range, and that's more than double now in the profile of transactions that we do now. And so that just means that you have businesses that are in larger addressable markets that are the 800-pound gorilla in their respective markets, and that might change the calculus a bit. But excuse me, but yeah, it's a good question. It's not something I have a great answer for yet. But we also need to, you know, we have our own kind of fixed and finite life of our fund, and we have to kind of manage that as well. So I haven't seen many secondary groups do continuation funds of their own continuation funds yet, but it'll be interesting.
Yeah, well, it goes to the fact that it's still a fairly newish industry, right? I mean, you guys haven't been around for 10 years that you have to talk about extending the life, but it'll be interesting to see what happens. I'm sure there'll be some assets that you have as well that you'll say, hey, there's still more runway here.
Yeah, no, absolutely. I think you're right about that.
Justin, thank you so much for taking the time to speak today. It's been an amazing conversation, and again, you know, we've been very privileged to be your partners over the last many years to see where you started and where you've come, and we look forward to continuing that journey with you.
Well, thank you. I'm very honored to be on here, and you know, appreciate the conversation as well.